For Morningstar, I'm Jeremy Glazer. We're getting ready for the 2017 Berkshire Hathaway annual meeting, and I'm here with Greg Warren. He's a senior stock analyst who covers Berkshire for us to see if the shares look attractive today. Greg, thanks for joining me.
Thanks for having me.
So as we go into the meeting, obviously we're focused probably more on what Charlie and Warren are going to say and what kind of insights we're going to get there. But a lot of investors want to know if this is a good time to get into Berkshire stocks. I thought we'd take a look at the valuation.
Yeah, it's interesting. The past 2 years, going into the annual meetings, the stock was relatively, fairly valued, or not fairly valued. It was undervalued. We had actually added it to our best ideas list back in May of 2015, ahead of the meeting, based on sort of that undervalue position relative to our fair value estimate. But the stocks had a pretty good run post the election. We ended up actually pulling it off that list at the beginning of this year after about a 14% run. At this point right now, it's trading at around 98% of our fair value estimate. The stock's about 17% above that 1.2 times book value threshold that Buffett has insisted on when buying back stock. So it's not necessarily, a screaming buyer, from a valuation perspective at these levels. There could be a case made for, an increase in the fair value anywhere sort of in the 7 to 9% range if we start toying around with tax reform in the model. But it's really hard to sort of get a handle on that because Berkshire, unlike a lot of smaller say asset light firms, it's not a matter of just adjusting the statutory tax rate. It's actually looking in at what the offsets might be. Will interest rate deductions go away? Will capital expenditures be immediately deductible from earnings? So there's will renewable incentives be taken away? So there's a lot of different parts within the system overall. And at the end of the day, Berkshire already right now has a blended tax rate of around 30%. So it's not likely to benefit as much from firms that don't have as much complications within the structures, or they're sitting at sort of a standard 35% statutory tax rate.
When you're coming up with that fair value estimate, are you kind of building models for each of the segments because they're obviously quite different, and kind of bringing them up? What's your process?
Yeah, that's the whole process because we use a sum of the parts valuation methodology. We strip out everything that's non-insurance from the insurance operations. We run that through our valuation model. We work with the railroad analyst on the BNSF section. We work with our utilities analyst on the Berkshire Energy piece. We do sort of truncated DCFs for the manufacturing service retailing, the financial products divisions, and then we sort of combine all of that up. We actually also strip out Kraft Heinz because we get a good sort of standard fair value estimate on that from our analyst, which is tied more to sort of a longer term value as opposed to what the market might be looking at any given time. So, from that perspective, we are looking at each of the pieces individually, and that's why when we start looking at tax reform, it is kind of an issue because BNSF and the energy businesses are heavy capital intensive businesses. There's a lot of questions around, if you take away interest deductions, how does that alter their capital allocation perspective? How do they think about capital? Do they pay down the debt? Do they continue to sort of invest as heavily in the business if they have straight CapEx depreciation? So there's a lot of moving parts there. That's why getting to sort of an easy answer is a little bit harder. But, at the end of the day, too, Berkshire tends to trade on book value per share. So sort of the quick back of the envelope, tells you that there's going to be at least a 5% increase in book value if there is a drop in the statutory tax rate, because just their deferred tax liabilities, which are tied to their investment portfolio, their stock investment portfolio, would actually go down by 5%, but that would be a 5% increase in equity.
When you look across segments in terms of growth, what's really driving it today? Is it more balanced? Is it the insurance operations? What's happening there?
Yeah, it's kind of a mixed bag right now. I mean, Geico is still sort of the bigger growth vehicle there. I mean, earned premium growth is still low double digits. The problem is their loss ratios have been much higher than normal and much higher than historical norms. We are seeing the same thing with some of the other auto insurers out there, so it's not it's not worrying us too much, but we prefer to sort of see them work that down. The railroad business is facing headwinds. I mean, coal's down on a secular basis, as well as more sort of weather-related issues the past couple of years. There's also concerns about intermodal. Whether or not the opening of the expansion of the Panama Canal is going to impact West Coast shipping business, and in turn, the carloads that BNSF and say Union Pacific pull out of those areas. And the energy side, that's steady and stable. Good relationships with a lot of the states. Decent increases where they need them. So that's more sort of an anchor, a stable business there. MSR, you've seen a lot of growth in the past year, but that was really from the Precision Castparts deal being added in, as well as Duracell. So I think this year is going to be a little bit, more sort of stable, steady, unless they do a big acquisition.
Overall, then, not a great entry point, but if you're a Berkshire holder, certainly nothing to maybe worry about in terms of the share price getting into too lofty of a territory.
Yeah, that's why it's been hard for us to get too excited about it. I mean, it had a huge run off of the election, once Trump won the presidency, because there was this big assumption that regulation was going to ease a lot, and taxes were going to come down a lot, and it's getting that into sort of real sort of physical results is going to take time, and I think for a lot of shareholders, they've got to be happy with the run up they've seen in the shares, but at this point, it's pretty much fairly valued.
Greg, thanks for the insight today.
Thanks for having me.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.